Right. Good morning. Thank you for joining Sullivan during our presentation today. We're going to be talking about the ATO Trust Distribution Rules, Section 100A, which have just recently been released by the ATO. These are also known as reimbursement arrangements. So it is a new focus from the ATO, and we need to be fully conscious of them. And I'll explain that as we go through today. Any questions, submit in the chat box and the question panel, and I'll endeavour to get those answered during today. Any unanswered, I'll get them back to you by email. If you have some challenging questions, I might have to take a bit more time because this is all new as far as we're concerned. The slides have been emailed to you, so hopefully you watch from here, but you've got them at home to look at. So what has happened? Well, the ATO has been pretty busy. They have released two important guidances this year. One is a ruling to do with allocation of professional firm profits, which is now a ruling. In the case of this 100A, it's a guidance statement that was issued in February. So we need to be conscious of where this is as far as the guidance is concerned. It is a change in the ATO approach as to how they look at distributions from family trust. The ATO attitude is that the profession was told about this in 2014, and they've remained fairly quiet in the background and not really talked about it. But they're focusing now to stop commonly used distributions to adult family members, effectively where there's a tax advantage. Now, just remember, this is a guidance statement, and we need to be conscious of that. The profession is fairly well up in arms. All the bodies have applied for extensions, for concessions, etc. The ATO actually were going to release this guidance last year. Then COVID hit, and someone must have had a heart in there, and they thought, no, we can't release it now because there's so much going on. So unfortunately it was deferred, but it's just a change. The ATO say it's not a change. We say it is a change. The issue, it can apply to arrangements both before and after finalisation. So you need to be really conscious when finalising family trust distributions as to what this guidance statement says and what will the final ruling say. So what is all the fuss about? It's the integrity rule of Section 100A. This was introduced actually by John Howard many years ago. I think it was around 2008. And it was focused on trust stripping arrangements. And after that, it just laid fairly low because it did what it had to do until 2014. The ATO comes out and says, oh, we need to be considering this in terms of all trust. So it's aimed at situations where the income of a trust is allocated to a beneficiary. So when we say the income, that's in the books, that's the accounting income. But the economic benefit, that is the cash, of the benefit of the distribution is actually provided to another individual or entity. So that's their actually focus. And so to summarise what it actually means, where there's a distribution to a beneficiary, there's an agreement between the beneficiary and the parent. And the reason we say parents, most family trusts have parents and children involved. That agreement can be in writing or just as a handshake. So it, as long as there's an agreement. And the parent will benefit from the distribution, that is, they get the cash, and there's a tax benefit. So the primary point here is there's a tax benefit. I'll touch on this again. I will be repeating myself a few times today just to drive home the importance of what the ATO are looking at and the different variations of their interpretation. 100A doesn't apply, but where the beneficiary is under legal disability, and that could be, for example, someone under 18. The arrangement is entered into in the course of ordinary family or commercial dealings, and we'll get to that in a second. And there's no tax benefit. In other words, they're not going to go chasing any rabbits down the hole if there's no extra tax to pick up. The issue is, what is ordinary family dealing? Now, back in 2014, when they issued their guidance statement, which is lay dormant, everyone considered an ordinary family dealing is dealing within a family. That's ordinary. This is what we do. The parents and the kids, this is what we do. Well, unfortunately, there's no definition of what this looks like. And in the applications by the professional bodies, they've now said, well, tell us what an ordinary family dealing looks like and what one doesn't look like. They're now saying that just being members of the same family doesn't make it an ordinary family dealing. Okay, well, give us some guidance on it. So the issue with 100A and the reimbursement arrangement is, what can the taxman do? Because you can go merrily down your way, the path that you've been following for years. But if they come along, they can invalidate the unsubstantiated distributions and tax the trustee at 47%. We don't want that. But on top of that, the worst possible position is they can charge penalties. And no one likes penalties, do they? So this really has opened up the concern of the profession. Hence the ATO had so many people putting discussion papers back to them that they had to extend the time for discussion by another couple of weeks. So hopefully they'll take things on board. And the ATO have said that there'll be more clarity on certain aspects once they've interpreted all the submissions. So what are the comments on the 100A? So 100A will apply where a distribution was made under an agreement, that's importantly, purposely designed to pay less income tax. So just summarise that. If you make a distribution on paper and the result is that there's this less income tax, but where the money goes to another person, that's what they're coming after. And the example is where a full-time student receives an entitlement from a trust under an arrangement, written or unwritten, where they agree to immediately gift the entitlement back to the trustee. And I'll go through an example in a sec. So the ATO is not concerned about ordinary family trusts where family members actually receive the distributions. So if the trust receives income and it allocates to the various family members, whether they're on a preferential tax rate or not, but they actually get the cash, there's no concern there. And they have actually said that there's a majority of ordinary family trusts are not going to be affected by their 100A approach. So this is a rather interesting one also. The ATO are not concerned when profits from a family business are distributed to family members, so that's the accounting distribution, and those members worked in the management of the business and the family member chose to reinvest the profits in the business because they didn't need the money, or actually they probably did, but the business needed it more because, you know, a lot of businesses, people, they reinvest in because they've got to fund debtors and they've got to fund stock and they've got to fund liabilities. So it's okay not to take the money out, but if the money is taken out by a person who's not the person who got the distribution, that is their concern. And the simple example is that Bill's trust distributes $100,000 to his adult son, Gary. But Gary's agreed to give that money back to Bill. Now, Gary's at university full-time, and he's on a much lower tax rate than Bill. For example, $100,000, his average tax rate is going to be probably 25%. But if Bill were to get the money, he's probably going to pay tax at 47%. So Bill will eventually benefit because Bill gets the money. Bill will pay the tax, of course, on behalf of Gary. But there was a tax advantage there. So it seems to be there's a tax motivation, and that's what the ATO is looking at. Targeting trust distributions to adult children do not actually receive the money. They benefit from a lower tax bracket. They're not targeting children under 18, as they can only receive $416 maximum, and above that it's 47%. So you know, there's no mileage in there. So what can a trust do? So you know we're concerned about the ATO 100A approach, but what can a trust do? Some guidance, please. Well, the trust can actually pay for the adult child university fees and treat that as a distribution. There's no problems with that. They can buy a car for the adult child. That's how the distribution allocated. Even come down, they can buy a carton of beer on Saturday night or the vodka, pay for dinner or holidays. Now, all of us as parents know it costs a lot of money for kids, especially those ones living at home. And so if you can track how much you've spent, that can be treated as a allocation to the trust distribution. I'm actually leaning here towards trusts having their own bank account because not all trusts have bank accounts. Operating ones certainly do, but Ones where just dividends flow through, they don't have bank accounts. But the best way to prove that the trust paid money on behalf of a beneficiary is to have a bank account. So, but that's something for other discussion. You can treat the distribution as a loan from the beneficiary back to the trust, provided that the trust repays the principal interest over a number of years. What you can't do is distribute $100,000 to a beneficiary and leave it there for 10 years. They're saying, no, the child never got the money. The economic benefit of that money went to the parent. So this is where they're looking, all these little tax advantage, big sums of money. I suppose in reality, and we don't know, we're looking for guidance. We doubt that the tax department's looking for $5,000, maybe $20,000. Who knows? One would expect these are de minimis because it's not worth their while chasing the rabbit down the hole to pick up $500. So you're looking at the tax differential on $100,000, perhaps the tax differential is $20,000. Yeah, that could be worth it, especially if they can do a few years at once. What can't the trust do? They can't distribute income to an adult child when they don't get the money. So I think I'm rehashing this, but that's the point of their focus. If the adult child didn't get the money, they can't distribute. They can't pay the cash to the adult child who pays it back later. And this is easy to check on the bank statement. So there's no say, yeah, we'll just do this behind the scenes. They will follow the money. And that's the key, of course. Follow the money. What's the money trail? It's not hard to pick up on that. It is okay to accumulate beneficiary accounts. So the trust can allocate income to a beneficiary, we'll say it's an adult child. And so they got a tax benefit, because they have a lower tax rate. But there's an agreement or an understanding that that money will be physically paid to them in two years or so to buy a house. We all hear of the bank of mum and dad, these days. They're helping children fund the house purchase. And so if you think that's going to happen, you allocate some money and you retain that money in the trust for whatever purpose on the basis of you're going to provide assistance to your child, that's fine. But they do say, the tax man says, that you need to be some record of logic, such a minimum agreement behind why you've accumulated that. And I'll come back to the $100,000, like 100 this year, next year, the year after. But there's got to be some reason for it, again, provided the money wasn't taken out by mum and dad. Come back to, was it 20,000? They're not going to be that interested. There's not enough tax to go and chase, my understanding. What the ATO has done, they've classified 4 risk levels. There's a white zone, which is low risk. There's a green zone, which is low risk. A blue zone, which is medium risk. And a red zone, which is high risk. And they give a lot of examples of the white zone and the green zone, which is pretty easy. You say, yeah, that makes sense to me. And they give some examples of the red zone. What we don't know is what goes in the blue zone, other than it's none of the above. It's interesting that they've chosen these 4 categories because in the allocation of professional firm profit tax ruling that came out this year earlier, the risk factors, similar to this, they only allow for 3 risk factors, but they were green, amber, and red. So amber to me is blue, and I hope I come out and say, okay, blue is amber. It's stand up. I've got your attention. I'm not quite sure whether I'm coming after you, but there's something there that we need to understand. So they've got examples from the ATO and from various professional publications that are okay, is where the trust distributes to an adult child to cover rent, living costs and university fees, and that pays the money to the parents or grandparents who incurred the expense. Now they have given the example of an adult child at uni living with the grandparents who gets paid a certain sum of money to board the child and to feed the child. And that's okay because the economic benefit has gone to the child. The trust can distribute to parents to use the money for their kids. Now, my view of this, we need to be careful. So you can't just come along and just say, well, give me $5,000 because that's what I spent for the kids. I believe you need to have a record of what you spent. Maybe not so much as food, like $100 a week in food. We know what it costs to bring a child up, especially as they get older. But you need to have some basis, some substantiation behind your approach. If the dealing's at arm's length on the commercial terms, that's fine, whatever that means. But it's not hard. Did it pass the front page test? Would someone have done this on a normal basis? Would the man or a manly ferry have done this? All the women, of course. Other examples where you distribute to the grandparents. So normally with the trust, you have the parents and the children. So the parents have the trust and the children are getting the benefit. But in the trust deeds, of course, many people get benefits. So the example is that the trust distributors to the grandparents actually pay the money to the grandparents who invest that money, but their will provides for the money to go back to the parents when they pass away. This is interesting because if the grandparents were on pension, well, they don't want the money. So obviously the grandparents need to be self-funded and they need to be able to reinvest it, which is probably controlled by the parents. But it's an option. The other option is actually, which is distribute and pay to a bucket company. So the bucket company sits under the trust. But again, the money, you follow the economic benefit. So the money goes to that company, which retains the funds, it invests the funds and hopefully makes a profit. And then when the child, or any children of the parents is over 18, the company can then pay that to the trust shareholder of that company as a dividend, and a franked dividend, on behalf of the child to cover university fees or buy a house. That one works quite well because, again, the money went to the company, it paid the tax at 25%, and this get paid out the franked dividends. So that works out fine. But what's not okay is where the trust distributes to an adult child on paper, where the cash sits in the parent's bank account or an offset account. So in other words, the economic benefit went to the parent. What's not okay? Parents claim for expenses against trust distributions for kids up to the age of 18. Now that's interesting because what they're saying, it was the parents' responsibility to bring the child up to 18. And 18 is a magic cut-off date because that's when they become a taxpayer on their own right. The question is, should it be 18, should it be 16? Many children have left home at 16 and got full-time jobs as apprentices. But what the taxman is saying, no, you can't claim, the parent can't claim against the trust for private school education up until the child turns 18. It had always been the view of the profession years ago, oh, no, we'll just claim for all those expenses, school expenses, etc. So again, the trust distribution to low-income adult children gifted back to the parents is a no-no. So I think I've covered off this a fair number of times now that we know where the taxman is looking, and it's not hard for him to find this once he digs into it. So the next steps for you to take are to review your trust distribution arrangements. Now, it is said that when the ruling is finalised, will apply from 1 July 2022. The contentious issue is if they're auditing your records in FY23 and they see something they don't like, there's unlimited, we'll call it retrospective adjustments. They can go back for your trust distributions back to 2014 or from after June 2014, because trust distribution or 100A is exempt from a limited period adjustment. So they're not going to really allocate resources to look at 2021, 19, unless you bring something to their attention. So if the taxman's out looking, if they look at 1 year, it's easy to look at 5 years at the same time. It's not a lot of work. So yes, it commences 1 July 22, but be wary. You'd have to think there's a de minimis. So as I've said before, they're not going to be looking at $5,000 or $10,000, but there's a limit where it tips over and they're saying, come on, there's a tax benefit here. This is not passing the smell test. That you're doing this purely for tax benefit and we're going to back all the years up and have a look at it. So just take care of the retrospectivity if you're in the red zone. So the red zones are all the ones I've said the taxman doesn't like these. So it is a matter of planning, considering your position for FY22 reimbursements. So, because there's 100 days without reimbursing, back to the parents from the taking the money from the trust and getting the economic benefit. I do have to say, don't forget, this is general advice today, and we just everyone needs to look at their own position before they make final decisions. What else have I got in here? Yes, well, we know it was a busy start for the tax man. Fortunately, they deferred it post-COVID. So I'm just going to look and see what questions we've got coming up here. Oops, I've gone too far. Okay, back to the questions. Here's a question from Matt. Thanks, Matt. I thought you'd be asking this question. The question is, can the trust reinvest the money into other investments on behalf of the beneficiaries? The answer is yes, it can, because it's actually on behalf of the trust. The key issue here is that the economic benefit had not passed to the parents, right? It was just reinvested back into the business, so or into the investments of that trust. That's nice and clean. Here's another one from Jenny. So if we have a trust with two beneficiaries, can the distribution be made to just the one with the low tax rate, and through a prior arrangement, they share the funds after tax is paid? That one's going to be on the nose a bit, because if it goes to the low tax rate, have we got a benefit? Is there a tax benefit? Yes. Is there an arrangement in place? Yes. So economic benefit goes to another person. So the answer is no. That 100 days is going to get your attention. But if it was a husband and wife and it was a clean trust distribution, and it goes into, say, the husband's bank account, who pays all the household expenses, so the cash goes into one bank account, but the distribution is shared 50-50 between husband and wife, that would be acceptable, unless there's some funny arrangement behind the scenes. So I'm fine with that. Another question, is the trust distribution rule law or draft only? It's a guidance statement at the moment. So we are expecting that they will have this wrapped up before the 30th of June, subject to the overwhelming demand. Keep going. This is a good one. Can I use trust funds to offset against beneficiary losses where another entity gets the economic benefit? That's a good question. The focus on distributions where there is a tax advantage and the economic benefit followed to someone else. So the economic benefit is the money. So if a distribution is made to a loss company, but the money didn't go to that loss company, that's in the target. But you can distribute to a loss company if the money goes to that loss company. And the same to if it's distributed to a beneficiary in a low tax bracket and the money goes to that beneficiary. They also are talking about focusing on distributions to non-residents. Not clear where they're going on that, so we wait for more guidance. Another good question, I think I covered off, but just in case, can the trust distribution be made to one beneficiary and deposited into a mixed bank account used to pay family living expenses? Yeah, that would seem to me fine. It's just that's a family arrangement, of course. I think I've just got a couple of questions here, but they're pretty well covered in everything I've said today. So if you have any other questions, feel free to shoot me an email. I'm happy to assist. Don't forget, this is guidance. It's not law yet, and we look forward to the ATO finalising this, and hopefully they listen to the profession, because it is certainly causing some disruption, disturbance, but we'll get it right. Right, thank you very much for listening to the Solomon During presentation. Look forward to catching up next time. Bye, have a good day.